Good afternoon and good evening, Australian expats. Welcome to tonight's session on the budget. Now, we appreciate that it's not normally the most exciting night for most Australians. For data nerds like ourselves, we get a bit excited, but we do have a number of things to run through today that do certainly directly affect Australian expats. So looking forward to running through those with you tonight. Just while we're waiting for people to come in, just a couple of housekeeping issues. What we're going to do is, as the course of the session, I'll probably talk for 30 or 40 minutes, and then we're going to throw it open to our live Q&A session, which for those who've been on the webinars in the past, have really enjoyed that. For those who are new to Atlas, it's pretty much a no-holds-barred scenario at the end. So if you have a question, don't be shy. What we'll do, there's a questions field on the tab in front of you, so you can just type out your questions. And certainly, by all means, type it out as we are talking so you don't forget it, and we can then run through that at the end of the session. Just got a few more stragglers coming in now. I often find like webinars are very similar to university assignments. No one arrives early and everything's at the last minute. So we always like to give a couple of minutes buffer. We'll just sort of give everyone 1 to 2 minutes more to filter in. Wherever you're watching this from, I hope you're safe and well. I hope you're navigating these incredibly difficult times. The COVID pandemic is, all bets are off at the moment. I've been in the game for 24 years, and in my time in the industry, I've been through the Asian financial crisis, the Russian debt crisis, tech boom, tech bust, September 11, the GFC, and to be honest with you, it feels like everything all rolled into one. So all those games, all those sessions, or all those events previously were almost like a warm-up session for the big game, which is what we're going through right now. When we're talking about the budget paper, to me, it's going to be, we actually go through the 700 odd pages, which, for most people, is not the most exciting of things, but you can really get quite a lot of insight into the government's mindset and how they're managing everything. So it's something that we're talking to clients on a regular basis about where things are going, and certainly, hopefully tonight's session will give you a bit of insight. Just so I want to make sure everyone's seeing all this. Okay, we've got a question here. Will it be recorded for those who can't attend now? Yes, certainly, Justine. We are recording this session, and that'll be sent out 24 to 48 hours after the session. We'll also be putting on our YouTube channel. We like to, we're not afraid of having an opinion, and also letting that opinion live on the in the social media landscape. So certainly for those folks who aren't aware of us, we do run quite a number of channels, which I'll run through at the end, and Facebook, LinkedIn, Twitter, YouTube, and Instagram if you like pictures, and that'll be uploaded onto our YouTube channel at the end of the session. Okay. Thank you very much, Lisa. Can hear and see you. Okay, nice comment. Okay, so guys, so I think we'll get the show on the road. I think the majority of the people have arrived. So I'm just going to start sharing my screen now, and just would appreciate if you guys can just confirm once you can see everything up on the screen. Okay, can everyone see that page there? Should be the capital of Canberra. Capital of Canberra, capital of Australia. Okay, fantastic. Thank you, guys. Righty, yeah, let's get the show on the road. So tonight, obviously, we're talking about the Australian federal budget, and at the end, we are going to run through our regular updates on the equity, property, and currency markets too. So hopefully, you'll be able to gain a bit of insight from that. No presentation from us would be remiss without having a disclaimer, and essentially what all of that garbage means in a short form is tonight is for essentially entertainment purposes only, and you should not construe that as financial advice. We recommend you go speak to a specialist and a licensed professional before proceeding with any topics that we cover through this evening. So who is Atlas Wealth Management? We're the leading provider of Australian expat tax financial advice, and we've been doing it for the better part of 10 years. We're classified as a tax financial advisor with the Tax Practitioners Board in Australia. In layman's terms, that means we're a tax agent that does not do tax lodgements. So essentially we do the tax advice side, but we don't lodge tax returns. We've got clients in over 30 countries, and our speciality is pretty much in joining the dots between managing your Australian assets and that country that you reside in. We hold an Australian Financial Services licence with the Australian Securities Investment Commission in Australia, as well as we've been licensed with the DFSA here in United Arab Emirates. So who are we? Obviously the guy on the left, he's got the good head for radio, that's myself, and my colleague James Ridley, who's our Managing Director for the APAC region on the right-hand side. James runs the Australian office and looks after clients in the Asia and United States and North America region as well too. So pretty much my job is to look after clients in Europe, Middle East and Africa. So we essentially cut the world in half, and both of us are now specialising in getting more detail in terms of different jurisdictions. So if you want to talk about punitive taxes on Australian ETFs in Denmark, then we can have that chat over coffee any time. So what we're talking about tonight, we've also got the budget at a glance, running through some of the key announcements regarding tax, migration, superannuation, and then some of the updates on the equities, property and currency markets, and then the Q&A at the end there. So let's run through the budget at a glance, and look, we won't go into too much detail on what was announced. There's a lot of things there that probably don't pertain to folks on this call this evening. So what we've gone through is pretty much stripped out what is important to you and what you need to be aware of. So the budget deficit of 213 billion, quite a sizable number. When you consider 10 months ago, the Australian federal government was forecasting a surplus of 6 billion. So we've gone from a positive of 6 billion to a negative of 213 billion. That gives you an insight as to what it's cost the Australian government in terms of debt. And we'll run through some numbers very shortly, which are quite sobering from a fiscal and monetary policy point of view. The budget deficit in 2020-2021 will be 11% of GDP. And this is an outcome not seen since the end of World War II. So just to give you an idea of the scale, it's a pretty big deal from a fiscal point of view. As you can see there, 1943 was sort of the peak of debt to GDP when it ran almost at 25%. So we're not quite at that level, but certainly an economic event to be reckoned with. And obviously at the moment our job with our clients is to help clients navigate these difficult times. To us, there are many sub-stories to the pandemic, and from our point of view, it's not all bad, but certainly at the macro 40,000 foot view, it's a pretty serious issue to contend with. So how do you spend 81.1 billion? What we'll run through here, so we've got the temporary reduction of the full cost of eligible assets for business with an aggregate turnover of less than 5 billion, which pretty much excludes the resource companies and the banks. Bringing forward stage 2 personal income tax cuts that were meant to apply in 2022. That's now retrospectively dated back to the 1st of July 2020. The JobKeeper payment extension, new transport infrastructure, temporary tax loss carryback for eligible companies. I'm not going to go into too much detail with this tonight because it doesn't really relate to a lot of folks on the call, but I will run through how they affect the economy. JobMaker hiring credit, additional $250 economic support payments to welfare recipients, and then enhancements to research and development tax incentives. So when we talked about the net debt situation before, this is where it sort of gets quite sobering. So essentially net debt at the moment is $491.2 billion. And as you can see, out to 2023-24, gets up to 966 and forecast to top the $1 trillion mark in the following year. The July 2020 economic and fiscal outlook, the government was looking at 488 for this year, 677 for next year, and then obviously didn't provide any guidance going forward because, in all honesty, they're still making the numbers up as they go. When we look at the figures for last year and the 2019-20 mid-year economic and fiscal outlook, they were forecasting 392, 379, 364, 360. So as you can see, a massive departure from what was forecast in July last year. And that last number there is pretty much telling the same story. So our view on the budget, look, essentially it's almost sitting at the 40,000 foot view, flying along and throwing money out of the window. What they've virtually done is they've tried to engage Australian businesses to spend money. And by spending money, that is both hiring and also to buying more goods and services, because if they buy more goods and services off another business, then they will hire and they'll go well. So they're trying to get that sort of that domino effect through the economy of getting money flowing and doing that. So essentially what they've done is they've rolled out a number of initiatives whereby a company can avail themselves of tax breaks. One of those includes the immediate expensing of assets. So a shoemaker can go out and buy a machine. Instead of amortising that and depreciating that over a number of years, they can actually do that all in 1 year. So essentially what they're saying is companies will get their money back when they do their tax returns in the following year. So they're trying to bring forward and really get the tills going in a lot of companies. And by doing that, the theory is that the money will hire more people, and then more people will obviously spend money, and the cycle goes around. So really it has been a challenge to the private sector. They've really, anyone below a value of $5 billion, they want to spend. Obviously the company's larger than that, the government believes, and rightly so, they have the balance sheet to do that anyway. So long story short, it really is a top-down approach when it comes to monetary policy. They're trying to get the companies hiring and spending money, and therefore that'll flow through to lower unemployment and more spending on the business side as well too. And another question that was asked today by a client, which I'll go through before I go on to the next one, do we think this was enough? And look, to be honest with you, I would have rather them spent 80% doing what they've said and what we're going to run through tonight, and then spent the other 20% essentially on infrastructure spending, building the high-speed rail between Melbourne and Sydney, some big picture items, because essentially what the government's relying upon is for that money to flow the whole way through. Our concerns is that once it gets to the consumer, and this is based on feedback we've received as well as looking at the data, the consumers aren't spending. They're saving as much as they can. And when you look at straw polls that have been conducted since the budget, a lot of people are saying they're not going to spend the money. Any extra savings they get, that $1,081 that everyone, on average is going to save, may not go through to other shops and other, other establishments. So that's our concern, whereas nothing sort of probably fires up any country more than, some big picture spending, big picture, type of projects. I guess the consideration as well is how quickly they can roll that out, as opposed to these types of measures, which, they're not quite instantaneous, but they can get them flowing within the next couple of months. So running through to everyone's favourite topic at tax. And essentially what they've done here is they're going to bring forward that stage 2 of the personal income tax plan, which they announced in the 2018-2019 federal budget. And what they're trying to do is avoid, reduce the risk of bracket creep. So now what they're going to do is, if you're earning up to $37,000 in the previous financial year, you would have been on the 19% tax bracket, and as soon as you earned $38,000, then you go into 32.5%. Now they're going to increase that threshold from $37,000 up to $45,000. So you can earn $44,000 in Australia as personal income, and you'll only be taxed at 19%. The top threshold now for the 32.5% bracket, that is going to increase from $90,000 up to $120,000. So I guess the perception that we've always had in Australia is we pay half in tax, but if you earn below $120,000 a year, then about a third of your money is going away in tax now. So to us, that's a good start, and we'll run through in the next slide just on the table how it looks. Essentially, stage 3 is going to be rolled out to 24-25. So as we can see here, these are the current thresholds up until now. So 0 to 18,200 tax-free. 18,200 up to 37,000, 19%, 37,000 up to 90, 32.5, so on and so forth. This is where the change is. So instead of going from 18,000 up to 37,000, they're going from 18,000 up to 45,000. And then instead of 37,000 to 90, it's going from 45 up to 120. So essentially, if you earn up to 120,000, you're only on the hook for now for 32.5%. Now, 2024-25 is a lifetime away, but if everything goes to plan, or pari passu, as the lawyers like to say, then what they're going to try and create is this, what we call a mega bracket. And what this mega bracket looks like is, if you earn from $45,000 and $45,001 up to $200,000, then you actually only pay 30% tax. And this is going to start to bring us back into line with a lot of other foreign countries in terms of how their tax rates look. This has always been slanted on the lower side in Australia, and as I said, a lot of water can go under the bridge between now and 2024-25. But if everything goes to plan, then that is a good sign from a personal income tax point of view for those who are looking to return back to Australia. These are some of the key points now that we see that do affect Australian expats, and these are actually some positives coming out of here, which is great to see. As I said, there's a lot of pages to go through, and this didn't get a lot of press, but to us, it was an important announcement to make. So the government's intending to modernise and expand the tax treaty network to eliminate double taxation and settle taxing rights between Australia and other countries. What that is in expat terms is the double taxation agreement, which you've probably heard about before, and essentially it avoids any sort of double taxing when you're trying to manage your multi-jurisdictional assets. So for people who are residing in countries that do not have a DTA, this is a positive, and they're obviously going to announce further details in the coming months in terms of what that looks like, in terms of which countries and so on and so forth. For the bulk of the countries, we obviously have DTAs with United States, UK, and all the major Western nations, but there are still quite a few countries that Australia does not have a DTA with. So we'll be providing further updates as that comes to the fore. This is a bit of good news for certain clients in certain regions. So when we're managing assets for clients, we talk about taxable Australian property and non-taxable Australian property. Taxable Australian property, house, apartment, mining lease, farm, anything that's physical you can kick, is taxed at obviously the non-resident marginal tax rate. Non-taxable Australian property, where shares, managed funds, ETFs, LICs, they do not accrue any sort of capital gains tax with the ATO. But what happens is you have what's called with non-resident withholding tax. And that non-resident withholding tax, essentially what that means is if you're in a country and you receive a dividend or an income stream from an investment in Australia that is a non-taxable asset, then all depending on which country you're in, will have different rates of tax. So if you're in a country that does not have a DTA or a information sharing agreement, then 30% tax will be withheld. If you're in a country that does have a DTA or an information sharing agreement, then 15% is only withheld. As of 1st of July next year, the following countries are now on the list in terms of only having 15% rather than 30%. So most of those countries would not be applicable. However, for clients in Hong Kong, Kuwait, we don't have any clients in the other countries. We do have one guy in Jamaica, by the way. But Hong Kong and Kuwait are two big benefits for us because right now, folks in those two countries are having 30% withholding tax withheld on income, and that will now reduce down to 15%. Managed investment trusts. Now, in the 2018-2019 budget, there was a proposal put forward to make some amendments with respect to this. Now, I don't want to get too in details about this, but it's probably a pretty important issue for those expats or non-residents for tax purposes who have investments in Australia that is in a trust. And essentially what they've done now is this change was meant to come in on the 1st of July of 2020. However, they've pushed it back now and it'll be commencing on or after 3 months after the date of royal assent of the relevant legislation. Layman's terms, that means whenever they pass this legislation, 3 months after, it'll kick in. Now, no guidance provided as to when. They haven't even drafted the legislation yet. So that could be 1, 2, 3 years down the track. Just for the sake of clarification, the way this works is if an Australian trust makes an investment in Australia, then as a Australian tax resident, that trust is a tax resident, they can invest and take advantage of local tax exemptions like the 50% capital gains tax rate deduction. Sorry. So the way that works, let's say for example a trust invests in an asset, that asset gets sold and that a capital gain ensues. What it means is that trust can then take advantage of the 50% capital gains discount, even though some of the beneficiaries may be non-resident who are normally not able to benefit. So essentially for those who've invested in this way, they're getting 2 bites of the cherry. The purpose of this legislation is actually to remove that non-resident's entitlement to get access to that. So why this is a positive is now, instead of that kicking in on the 1st of July, that won't kick in for probably the better part of the next 1 or 2 years. Obviously the government's going to have their hands full with respect to other legislation that is probably more important. And once again, we'll keep everyone updated on that. I won't go into too much detail on the way it works here. Pretty much as I explained, the trust can claim a tax exemption or a tax discount on the asset sale, and essentially that passes through to a non-resident investor. So the proposal is to remove that exemption from a non-resident's point of view, and try and bring it back into line with other asset classes, as if an expat was investing in Australian property, as an example. The migration announcement is a positive announcement, and essentially, obviously we'd love to see an announcement regarding the border caps, because it's just heartbreaking, all the stories we talk to people on a daily basis who are trying to navigate this very difficult space. But we do have some good news for those who are trying to find or obtain family visas. So essentially, they're going to increase a one-off allocation from 43,732 places up to 77,300 places. So 72,000 of the 77,000 are going to be allocated to partner visas. So I know there's a lot of folks out there who have mixed nationality marriages and who are trying to get their partners a permanent residency. This is the news you want to hear, because at the end of the day, combined with the bottleneck of people trying to get back, we do have a lot of folks out there who are Australians who are married to someone of a different nationality, and they've lost their job. And that person, probably has to go back to Australia because they don't have a job where they live. But unfortunately, we're going to see couples split because their partner, who does not have permanent residency, coming back to Australia. So this is great to see this increase in the allocation, and applauding the government there. Obviously, there's a family sponsorship provisions, including mandatory character checks and all that sort of stuff. That's goes without saying. The main point is the partner visas, the allocation has been increased. So superannuation, look, we think there was a number of positive announcements coming out on this. The first one is the best interest duty. So as a licensed professional, we have to have our clients' best interests at heart. We can actually be sued if we don't have our clients' best interests when we provide recommendations. What the focus here is to focus on the super funds and ensure that when they're spending their members' money, that they're doing so in the best interests of their members, and there's a reasonable basis to support that expenditure. Best example of that, we've all seen the industry super funds, they sponsor everything. I think it's Host, they're always at the tennis. We have a lot of stadiums that are sponsored by funds. Essentially that, in theory, will be going away. And I think that's a good thing. And I understand how Host sponsoring Australian tennis will benefit one of their members in terms of returns. So to me, it's more of a junket or more of a brag factor or whatever it is. We can leave that over a beer another day. But to me, this is a good sign, because a lot of the trustees weren't held accountable in a strict enough sense to spend money. If they're going to spend money, certainly spend it on IT to improve their ability to manage their clients, or obviously looking at investment returns. To me, sponsoring an event doesn't benefit a member of those funds at all. Another positive announcement is the underperformance checks, and I think this is a great one. So essentially, Australian expats, when they're in Australia, they're constantly reminded to manage their super and do the right thing. As soon as you get on that plane and fly overseas, your super in Australia becomes a bit of an afterthought, and you only really think of it once a year when you get that email from them with the annual statement, and most people either file it into a folder or put it in the rubbish. What they're going to do now is essentially there's going to be a performance assessment on super products, more specifically My Super products, and essentially what they're going to do is every year these funds will be rated, and if a fund underperforms for year one, they must notify their members. So there's going to be a benchmark set, which is an industry standard benchmark. A fund which underperforms for 2 consecutive years will be prohibited from receiving new members until it ceases to be underperforming. So what they're saying is the onus is on the funds to provide not only realistic fees, but also realistic returns. So there's going to be a balancing act between fees and returns. And if you don't meet that mark, then you're going to be publicly embarrassed. And I think it's a great thing. There's too many legacy funds out there who are charging a lot of money for little return. And it's always disheartening when we review clients' super funds and see some pretty mediocre results. The other positive for super is the stapling of super accounts. What this essentially means is, what's the best way to describe it? When you start working in Australia, you get given a tax file number. Every time you change employer, you don't get a new tax file number. That tax file number follows you around, and it saves duplication. There's about 6.6 million duplicate super accounts in Australia right now, and it's something we sort of like to highlight and sing from the heavens. If you've got 2, 3, 4, we've had people with 9 super accounts before, you're paying the minimum admin fee across every single one, which can be reduced down to 1. If you're paying $500, $400, $300 a year for these admin fees, times up by 3, 4, 5, or 9 in the most extreme cases, and essentially you're just throwing money away. The way this is going to work from July 2021, when you move employers in Australia, the way it's going to work is your fund will follow you. So the employer does not set up a new fund, and it essentially means that you don't have to dig through all your details because it's going to be attached to your tax file number and your payroll. So essentially when you join up, they're going to pay automatically into whatever's attached to you. So what we're saying to clients right now, it's always a good idea to go through and review your super, making sure that you are investing or have your money invested in a good fund, so that when you do return to Australia, you don't have to dig it out. It's already there working for you, working in the background. And as you change employees in Australia, you don't have to go through and dig up the old details. It's going to follow you around, which is fantastic. So, we're very happy to see that. Obviously, a lot of unions weren't happy with that, and the reason being is obviously they lose their control in terms of mandating via their EBAs in terms of where your super is to go. They're obviously going to favour the industry funds because they are part owners and participants of those funds. So it's going to be interesting to see what the rhetoric comes out of this in the coming weeks and months as the details are announced. But long story short, I think this is a positive. People have too many funds, and a lot of money is being wasted. And for those who are experiencing financial hardship, the government has extended the application period for the $10,000 drawdown in super out to 31st of December 2020. Just to clarify, we have gone through all the legislation, the explanatory memorandums and everything. There is nothing precluding Australian expats from getting access to that 10,000. The only condition is you must meet the conditions of release, and they're quite detailed. They're on our website. If you look under our blog articles, we do go into a lot of detail there. For those out there who think, oh, well, how are they going to know if my income overseas dropped or not? Thanks to the Common Reporting Standard, they will. There's 146 territories and countries that do share data around, including the UAE between Australia. So if you've got an Emirates MBD account, a FAB account, doesn't matter what it is, they know how much money you're earning. They know how much money is going to your account every month. So if you are going to make an election and take that 10,000 out, please do it on a best interest basis, e.g. make sure you do qualify. And the last one, which should not be applicable to expats, but there are a number out there who do have self-managed super funds, and these were set up before they moved away. And look, we'll go into on another webinar another time why you should or shouldn't, but for those who do have it, in the 2018 budget, the government proposed to increase the maximum number of members from 4 to 6. This measure has now received proposed to commence from the date the enabling of legislation receives royal assent. So that is a positive for those who do have SMSF or small APRA funds who are non-residents. So now running on to the equity market updates, and to me, it's always difficult to work out where everything is at the time, because you wake up one morning, there's a headline saying up and down and up and down. It's very hard to form a picture. So picture tells 1,000 words, and what we put up on the screen there is essentially the ASX200 over the last 6 months. Sorry, 12 months. No, 12 months back to beginning of the year. So essentially what we're seeing here is obviously the market falling into March. Then we saw a bit of a relief rally, and essentially from the beginning of June, the market has just tracked sideways, and it'll wax and wane all depending on news flow. However, we're now in this situation where, as you can see, we're retesting those lows just down below 5,800. From memory, it's about 5,776. And until we see clear conviction coming out of both the medical fraternity and the governments that there is an end in sight, we see the potential of, in the short term, weakness, e.g. opportunity, but then with the amount of cash flowing through, obviously opportunity as the stimulus packages start to take effect and we start to see money flow through the tills. So I guess in the short term, to us, there is downside risk, which in our book is opportunity. But then we don't think we'll go back to the March lows. That was when essentially we're looking a bit of an abyss and the market really wasn't sure what we're dealing with. When you look at the budget numbers and look at more so the commentary that came out of the budget yesterday, the Australian government's not talking about having a vaccine until the end of next year. They're not talking about having international borders open to tourists until the end of next year. So I think as we settle into this, we'll start to see things settle down and start to see things pull back a bit. But then, for us, that is the opportunity. And essentially when you're investing, you want to be paid enough of a potential return for you to assume the risk of entering the market. And that's how you essentially work out whether you invest or not. Are you going to receive enough of compensation for the risk you're assuming? So for us, it's probably on the line right now. We think there's a little bit more to go, but certainly in October, for us, it's going to be a decisive month because obviously now that we've got Trump announcing there is going to be no packages or stimulus packages announced before the November 3rd US election, the market may drift. And what we're going to start to see out of this is whether if Trump's situation improves or not, obviously with respect to Corona. If you follow his Twitter feed, he is, but what's happening in the background, that's the other question. To me, the biggest question is going to be is, obviously a Trump versus a Biden will affect the US dollar, will affect the US stock market as well. And going forward, we're going to start to see the market try to factor in the results. And those results will be factored in based on, opinion polls and all those things as we build up into that election. That's going to create a bit of volatility, and where we sit, volatility is, it's always a good chance of getting some opportunity to obtain some good assets, because what we start to see is once we go through that point of uncertainty, then the market's forward-looking. It's looking at 12, 18 months, and as the candidate that wins is firmed up, and then obviously with the election is locked in, then the market can look forward and essentially calculate how the economy is going to go based on which candidate's going to get in. Interesting enough, a very simple stock market metric has correctly predicted the winner in 20 of the last 23 US presidential elections since 1936. So if the S&P index, S&P 500 index, I should say, is up in the 3 months prior to election day, the incumbent party usually wins. If the markets are down during that period, the opposing party typically claims victory. So what does it mean for 2020? Well, as of September 15, the S&P 500 was up 3% since August 3, which is 3 months prior to the election, and 5% year to date. So in normal times, that would favour Mr. Trump. In today's COVID period, who knows? Since interesting fact, since 1912, only once has a president been re-elected if he oversaw a recession within 2 years of the election. So in that number, that would favour Biden. But if you look at that middle number of up, then that favours Trump. So as you can see right now, it's a little bit too early to call, and October is going to be a very interesting time to watch. So here's the numbers, and that grey period is that period pre the election. So as you can see there, when the incumbent party won, returns were good, and when the incumbent party lost, the returns were negative. So it's going to be an interesting one to watch, whether this plays out. I put this sort of thing up there not as an investment thesis or a reason to or not to invest, more so just as a bit of a fun fact to watch anyway and see if it pans out, because these things are always interesting, and it's always interesting to see from a data nerd's point of view how these things look post the election anyway. On the Australian front, essentially we've got a 3-horse race going on here right now. So you've got the resources sector, the financials, and all others. As you can see there, the banks aren't having a good go. In actual fact, the banks are down since 2014. They haven't actually made a buck on banks. And it's one of the reasons why, if you attended our other webinars, we talk about the risk of buying purely an Australian ETF to get access to the ASX market. The reason we don't like that is because banks make up 38.5% of that index. If you want your portfolio performance to be beholden to the banks, then an ASX 200 ETF is the way to go. We prefer using ETFs for international exposure, but on the Australian exposure to actually do sector-specific investments as opposed to just a blanket one, because as you can see there, if you're invested all in the banks, and look, to be honest with you, up until 2014, the banks were killing it. They were paying great dividends. They had great capital growth. And we've seen portfolios where banks made up 60 to 80% of their portfolio. If that was the case now, then you'd be well and truly underwater, and that was even pre-COVID. So, to me, it's always about diversification is the most important part. And what's probably saved Australia to a certain degree is we don't have a lot of airlines. We don't have a lot of these other sectors, or hotels that make up a large part of the sector. And on the next slide, we'll give a bit of a breakdown in terms of what sectors have been performing the best and the worst in the first half of 2020. So this is what we call it, a bit of a fertile ground for stock picking. As you can see running through there, the best sector on the far right-hand side of that first chart is essentially IT. No surprise there. Everyone's on Zoom. Everyone's on Microsoft Teams. So the same thing for Australian IT companies as well. The other sectors that have performed well, consumer staples virtually like a Coles or Woolworths, those sort of companies. Everyone's buying lots of toilet paper, or was, and still I think the shopping from home from a grocery point of view has really caught on in Australia right now, and we're not expecting that to sort of pull off anytime soon. And obviously healthcare as well. When you're looking at companies like Sonic Healthcare, which a lot of people don't know who is, but when I say they're the owners of Sullivan Nicolaides, Queensland X-Ray, they go, that's who they are. They're obviously having a very busy time. On the extreme left, we've got energy, and that's essentially a two-part argument. The first part was obviously the oil wars between Saudi and the rest of the world in terms of what's going on there with the oil agreements in OPEC. Combined with obviously planes aren't flying, economic activity is down. So demand for oil and energy stocks or energy materials has certainly dropped off significantly. So that's why they're the last performer. Real estate financials, as I said before, the banks aren't doing very well at all. And I'll run through that in the next topic with respect to property on our concerns there. So what we see here is a great example of why you shouldn't just buy across the top. There is going to be a time when you do want to buy energy, real estate, property. But the biggest thing for us at the moment is there's so much uncertainty surrounding, obviously the uptick when it comes to demand for energy. When are the planes going to start flying? As I said before, Australia, reading the tea leaves of their budget response yesterday, they're not allowed tourists into Australia until the end of next year. There's a reason why Qantas have mothballed the whole international fleet until at least March 2021. So, that travel side is really going to be on the nose for the better part of the next 12 months. Certainly when you look at real estate, on the office side and retail side, there's going to be more work from home. Any company you talk to these days is downsizing their requirements of their space. Up to 20 to 50% of some companies have now suddenly worked from home permanently. They don't need all that office space. Retail's the same as well. When retail companies were shut down, they had to pivot straight across to online. Now they're sort of looking at their lease payments going, well, do we need to be spending such a large amount to have a physical presence? There's going to be all these changes going through, and until we see a bit more certainty coming through in terms of the longevity of the COVID pandemic, to us, those far three sectors are the ones to probably be most wary of. And look for companies and sectors that have a roadmap and how they're navigating the COVID pandemic. And obviously those first three there with respect to IT, healthcare, consumer staples, they're doing very well. So running through now onto the property market, and we have a concern with the property market in that we don't think they've paid the piper yet. And the reason being is essentially the whole property market's been artificially held up by some of the key things, including the rental eviction moratorium, the number of loans. 11% of Australian mortgages are deferred, and that is a big concern. So those two things combined with a big problem in terms of the stage restrictions, open homes and auctions. The concerns regarding that were the market wasn't able to adjust in terms, and that includes a downward trend in price, to take into account the concerns from an economic point of view and from an asset point of view. So now here we are, beginning of October, and all those little things are starting to unwind. And big concern is certainly the extension of the rental eviction moratorium that is hurting a lot of landlords, people to decide not to pay. And you are going to start to see people selling property with a possible tenant in there who's not paying, because they can't afford to make their mortgage payments. One big concern for us is 1 in 5 customers who have deferred loans are ghosting banks, which means they're not responding to letters, emails or phone calls. The banks are reaching out to try and manage this situation, and the better part of 20% of people aren't even talking to the banks. So if we are looking at that as a representative factor of how it has affected the mortgage market, so that 11% of Australian residential loans which have been deferred amounts to about 254 billion. So now we're looking at around about $50 billion worth of loans with a lot of uncertainty. And obviously that can translate into mortgage in possession sales and some quite adverse things. And we haven't seen that yet. We haven't seen that. The banks have been very conciliatory with their customers, but at some point that is going to stop because it is costing them money. And the last one is actually negative migration. And we saw some very interesting data coming out of the budget yesterday, which I'll run through shortly on those migrant numbers. On the property market, essentially there's 4 categories of participants. There's first home buyers. Well, we know a lot of them have suffered the most. That's why the budget was really singling out those young 16 to 26 and 26 to 30, 16 to 29 and 29 to 36 year olds having that stimulus package to encourage employees to hire them. They were probably the hardest hit of any of the demographics when it comes to unemployment. So that has essentially pushed them out of the market. If you look at the numbers between 2 and 3 years, we're not going to see the same weight of numbers when it comes to first home buyers like we saw pre the pandemic. Owner-occupiers are really the only people out there who are doing anything. And for those who dialed into our market updates previously, we did a complete analysis breakdown of, what activity we're seeing in both owner-occupiers and investors. Investors left the building in 2018, 2019. So in actual fact, the scenario with the number of investors going to the market has deteriorated even before the pandemic occurred, and this has just increased it. In the past, the Australian property market has relied on migrants to take up the slack and take up the supply. But as you'll see in the next couple of slides, migrants will not be a factor of the property market for the better part of the next 2 or 3 years. So just running through those coming out of the budget, net overseas migration, essentially that's the offset of the amount of people leaving Australia permanently versus moving to Australia permanently, significantly affected by international travel restrictions and obviously weaker labour markets domestically and globally. It's assumed to fall from 154,000 persons in 2019, positive, the amount of people, when you net off between those leaving and those arriving, to negative 72,000 persons by the end of the 2020-2021 financial year, so that's July next year. And this will slowly and gradually turn around to being positive again in the 23-24 financial year. So those are the numbers there. Essentially, we're seeing the Australian population expected to fall by 0.2% in 2020-2021, which, in my years, I've never seen that, before, and then 0.4% in the 2021-22 year. So this is the slowest growth in over a century, and obviously due to this, expected to be negative over the period for the first time since 1946. So those who are looking at property markets, and we're talking primarily the Sydney and Melbourne markets, to us in that migrant entry category of property, they're the areas that they're going to be affected the most. I don't think Point Piper is going to feel the brunt there, but certainly there's a lot of other suburbs that will. And last of all, we're talking through on the currency. So where's the Australian dollar at? Well, in September, it broke through 74. Then the Australian dollar fell against most major currencies. Obviously, these second waves that are occurring in some countries, including Europe and the UK, has dampened expectations of global growth and obviously, the resurgence of the economies. as well as the US election uncertainty is driving a risk-off approach. Now, those who've been sort of following us for the better part of the last 8 months with these COVID webinars will know that we've sort of gone into quite a lot of detail what the risk-on approach is. But essentially, when investors are nervous and they don't know what to do, they run back to virtually the world's treasury currency, which is US dollars. So what we're seeing right now through the better part of July and August, a bit of green shoots were showing up. We're starting to come out of this. We're managing it. Off we go. And we saw the Australian dollar appreciate. Also bear in mind too that there's 18% more US dollars in the market than there was when things kicked off back in March with the broader market. And that's as a result of the US Fed printing more US dollars and flooding the market. So essentially the Australian dollar did not appreciate. It actually, US dollar depreciated, and that's what caused the appreciation of the Australian dollar. However, what we're going to start to see is Australian interest rates start to really come in, and should we see obviously interest rates fall in Australia, then there's a very real chance that the Australian dollar could get back to the 68 to 70 cent range in the short term. So on Tuesday, the Australian RBA hinted at that it may ease monetary policy next month, which has caused a sell-off in the Australian dollar. Obviously, policymakers elected to leave interest rates alone. This month, there was talk about a rate cut on the same day as the budget. It didn't happen, but the impetus and the reasons for a 0.15 or 15 basis point cut in the coming months, as well as QE coming in November, is certainly going to weigh on the Australian dollar. Essentially, investors around the world, like I said before, when you invest in something, you want enough of a return to assume the risk. Now that the Australian official cash rates, more than likely will come back next month, international investors will start to pull their cash out of Australian dollars back to US dollars because there's not enough of an offset in terms of a reward for investing in Australian dollars and getting those returns. So the US elections are obviously a big determinant of what's going on with the Australian dollar as well. So obviously the Australian dollar right now is consolidating, and that could actually come down further. We're obviously going to start to see a lot of dialogue coming out of the US, and that is going to really dictate what the US dollar does, and in turn that will have an effect on the Australian dollar. Certainly Trump announcing he's not doing any more relief talks until after the US election is a concern, and that's why we have started to see the Australian dollar weaken off against the US dollar as the US dollar starts to strengthen up as the investors take a risk-off approach. So the expectation of a government-led support has been a key driver behind the positive sentiment in recent months. Like I said, July and August, everyone was spending, and the market took umbrage in that, and they said, right, we're going to spend our way out of this. However, the longer this goes on, the more uncertainty becomes available, and certainly a vaccine tomorrow would reverse this on its head and game on. But being realistically, I don't think we're going to see a vaccine tomorrow or the next month anyway. And we're obviously all watching that AstraZeneca and Oxford vaccine go through its respective trials. So this is here pretty much the market playing the US dollar safety card. So as you can see there, back in March, US dollar safe haven. If you don't know what to do, if you're frozen by fear, analysis paralysis, just go to US dollar and wait this out. Then as we saw things start to settle down, we saw this strength in the US dollar start to come back. However, as you can see there, it's now starting to pick back up again. Obviously, Trump getting COVID didn't help the market, it created more uncertainty, and obviously the market has its view on whether Biden or Trump should win. In terms of how that will affect both the currency market and the equity markets, it really is, it's not a given at the moment because we're still starting to see, we're still waiting to see a lot of policy announcements coming out over time. Okay, so run through, let's go into the Q&A. I'm just going to have a drink a glass of water, and folks, if you could just start typing your questions there, we'll run through those in alphabetical order. Sorry, chronological order. Okay, Lisa's asked a question. Does the UAE have an information sharing agreement or a DTA with Australia? No, it doesn't. The Australian relationship between Australia and the UAE only extends to what we call the Common Reporting Standard. So the Common Reporting Standard is a data sharing agreement, but an information sharing agreement or a DTA is a lot more detailed, and it's actually a country-to-country negotiation as opposed to a larger framework, which is the Common Reporting Standard, which is run by the OECD. So the answer is no. At the moment, it creates a few issues for corporates when it comes to how they treat tax from a GST point of view and a VAT point of view. So it would be good for Australian companies to have a DTA there. Obviously, it'd be good for investors in the UAE who are investing in Australian shares. If those shares were to not receive franking credits, which is 100% offset of the non-resident withholding tax, if it is fully franked, then in that case, that'd be a good thing as well too. So to me, you'd have to read the tea leaves when the government said they're going to talk to a lot more countries about it. You'd have to think, as a large trading partner with Australia, that UAE would be on the top of that list. It just depends on whether the UAE wants to be party and privy to those talks as well too. Question from Mum. On the last webinar, you suggested considering deterring any Australian property investments until mid-2020. Is that still the guidance? Cheers. 2021, yep. Look, yeah, definitely. From our point of view, and once again, any of my comments here tonight are for entertainment purposes only and should not be construed as personal financial advice. There has been no purge. We saw mortgage default rates, and Martin, if you're on the call last time, you'd notice those charts I put up with respect to default rates. Default rates before COVID kicked off were 1.5 times higher than default rates during the GFC on Australian mortgages. So even before we got into this scenario of a pandemic, people were defaulting at 1.5 times the rate of when we went through the GFC. So to me, we haven't seen a clear crystal market. Obviously, the difference between the property market and the equity market is the equity market will adjust instantaneously within a matter of microseconds to any news or anything that flows through. In the property market, you only get that crystallization moment when there's a sale, and when essentially for landlords who can't sell because they've got almost a tenant squatting in their place because they refuse to pay, that's a problem. Then you also have scenarios where there's a lot of investors out there in the Australian property market who really only should have owned 1 or 2 property and owned 5, and virtually they took equity from one to the next. So they're running on negative equity. And you might remember in that last chart in the last property update, we went through and looked at, I think it's from memory, 11% of all deferred mortgages have an LVR or a loan-to-value ratio of less than 90%, sorry, greater than 90%. So all the, for 11% of those mortgages, all they need to see is the market pull back by 10% or less or greater, and from their point of view, they're in negative equity. And that's what's got the banks frightened. And that's where the banks right now are actively calling people to try and get them either to sell or find out how they're going to try and manage that situation. Certainly the banks will step in and stop playing Mr. Nice Guy at certain points, and they'll start to do mortgage in possessions. And once we see that purge start to happen, that's when we're going to start to see a true reflection of what the Australian property market should be priced. At the moment, you are not getting any return upside for the risk you're assuming, and to us it's a risk return strategy. Stephen asked the question, does the CRS include the definition of Australian super funds? So they are recognised as pension funds in the USA. Great question, Stephen. So for those out there who are not familiar with the situation in the United States, in the US, believe it or not, the IRS are the original founders of the Flat Earth Society, and they do not respect or understanding that happens overseas, including the fact that they did not classify Australian super accounts as a foreign pension. They classified it as a foreign trust. Now, page 42 of the FATCA agreement between the United States and Australia does say that Australian super funds are excluded from reporting data as part of the FATCA agreement. So FATCA is the US version of CRS. However, we do know that some of that information is being shared. And unfortunately, there are Australian expats in the United States who aren't aware of that, and they have to do, every year they have to do what's called an FBAR report, and that includes declaring your super. If you don't declare that, that's a US $10,000 fine, and we're seeing people getting fines from the IRS of between $20,000 and $50,000. So it's absolutely crazy, and sometimes that's more than the balance of the fund itself. So Steve, from that point of view, we always highly recommend our clients take a conservative approach. If your super is properly structured, then you don't have anything to fear by the IRS. Making sure there's no PFICs, it should only have direct equities and international US listed ETFs only. But unfortunately, we can't rely upon that page 42 of the FATCA agreement, because we do know of cases where there has been disclosure to the IRS. Question there from Caroline. If I'm living in the UK and withdraw super into an Australian bank account, will I get taxed because I am overseas? I've reached preservation age but not retirement age. Look, it depends. When you look at, and this is, I probably can't go into too much detail, Caroline, because this is a personal question, and if I answer it, it'd be personal advice, obviously specific to you. What I will say is, when it comes to drawing down on your super, if it is, as you said, you've reached preservation age, then you will need to look at the DTA between Australia and the UK. We do have a lot of people that do that, and there's nothing wrong with that. Some countries will tax you, some countries won't. Depends on whether there's an exclusion inside of that DTA that says if you paid tax, there's a taxing right in Australia, and they'll recognise any credits from that as well too. So, certainly reach out to us. I'll just put on the page there. So for those folks out there who just want to find a bit more information, you can jump on our website, atlaswealth.com, go to the contacts page, fill in an inquiry form. Both the Australian office and the Dubai office, we do a 30-minute complimentary consult. It's at our own cost, just to ensure that we can, assist. There's no charge to yourselves. It's just 30 minutes of just going through and understanding your scenario, and then we can go through and sort of talk about that in more detail. But yeah, unfortunately, Caroline, I can't really go into specifics in your question, because it would be considered as personal advice. Question from Abdul. Hello, you really seem to have a lot of information. Thank you for your webinar. My pleasure, thank you. The question from Helen. Where are we here? The capital gains tax main residence exemption for expats was abolished this year in July. Good news in the new CGT exemption for granny flats coming in next July. Yes, it was. Is there any news on expats purchasing in Australia when living in the UK? Being an Australian passport holder, is there any news on expats purchasing in Australia when living? So, okay, so I guess the question you're asking, Helen, is do we think that the main resident exemption will come back for expats? Unfortunately not. The government has been unequivocal in their stance on this, and we pretty much threw the book at this since 2017 when they first announced it. We had petitions signed up. The latest petition that we provided to Canberra was at the end of May. We had a better part of 2,000 signatures on that. Fell on deaf ear. Very kindly, Treasury emailed me, I think it was August, to say thank you very much for it, but no. So they're unequivocal on that. To me, yeah, it's a way for the government to gain revenue. Unfortunately, we have come across cases on a weekly basis of people not even knowing that there's a change in the legislation, and then they've sold post 1 July without knowing what these changes, and then they've called us to say, how can we fix it? It's one of the most punitive taxes I've ever seen in my career. Potentially it dates back to 1985 when they introduced CGT, and long story short, I think the chance of getting that change, to use an Aussie phrase, is buckleys. Caroline, no problem. No, she said, always happy to answer questions, Caroline, as long as they're sort of general nature. As I said, when you're drawing on super as a foreign resident, it's always important to understand how both sides of the equation work, both where your super is located and also where you are domiciled. As an example, and I can sort of throw out examples to give you an idea of what's going on, Italy, which has a social security agreement with Australia and has a lot of foundations and long-term ties with Australia, they, believe it or not, tax people on the pension, when you do an allocated pension and start drawing down that fund. So every country is different, and very important to understand those nuances. Question from Brendan here. Has there been any clarification from the ATO on reports that they are no longer treat gratuity schemes like the Singapore? Look, there's a litany of private tax rulings that have been coming out over the last couple of months, certainly from Hong Kong, Singapore, and the United Arab Emirates in terms of provident funds. And Section 99B, they are steadfast. If you have, and sort of I'll take a step back to explain everything in the background there. in a lot of countries, you have like a super-like scheme, and if that money is invested into a trust, then that's where the complicating factors happen. So let's say, for example, you're in the UAE and we have what's called an end of service benefit, which is essentially an accrual in the background of like a 13-month of a salary. Now, if you get paid that money and you leave and move back to Australia, that's not a problem at all, because essentially that's from income that's earned in the previous years. For those people who do work under a provident fund, and this can be Emirates Aircrew, the recently introduced DWS dues savings scheme for those who work in the DIFC, Singapore, Hong Kong. What happens is the ATO really hasn't lent on this for many, many years. It's only in the last couple of years they've got to be in their bonnet about it. And to me, they're misinterpreting the ruling. But anyway, they're the ATO and I'm just Brett. What they're saying is, if you accrue a benefit in the background and that money is invested and you are to sell that investment down in the same financial year that you return to Australia, then you will be taxed on that growth of that investment over the period of time. So for those folks out there who do receive an end of service benefit, but it's not, you can't select balanced or growth or how it's invested, then this doesn't apply to you. For those out there who do have a savings scheme where it is invested in a trust, and you do, obviously it is invested in the market, then you need to be very careful of this, because essentially what it means is if you do crystallise or sell this down, you don't want to be returning to Australia in the same financial year, Australian financial year, as when those gains are crystallised. So I guess in a very roundabout sort of way, Brendan, essentially no more clarification. If anything, it's just more conviction from the ATO. Okay. From Pankaj, thanks Brett, great information, my pleasure. Martin, thanks Brett, fantastic as always, my pleasure. Righto guys, is any other questions there? Don't ask me who's going to win the election. I think from the US point of view, yeah, there's a bit of subterfuge going on and all sorts of things going on there, so that's going to be an interesting one. To us, the next 2 months is going to be an incredibly busy time from a just a benchmarking point of view in terms of who's going to be sitting in the White House, what's going on with the pandemic, what's going on with the any sort of vaccine. When you look at all these sort of scenarios playing out one after the next, individually they're massive issues, but when you combine them all together, really does get, it can feel like drinking from a fire hose. So certainly there's going to be a lot going on over the coming months. For those who are on the social pages, we do run a number of pages. Certainly the first two are our main conduit when it comes to updating expats and keeping them focused on what's going on with respect to different rules, regulations, and certainly topics they need to be aware of. Certainly, like and subscribe on our Facebook and LinkedIn page. Also, too, this will be on our YouTube page as well. So what we're going to do is, this session is being recorded, like I said earlier. We will be sending this out as a recording, and you can watch this back. You can certainly fast forward and skip the boring parts and sort of delve into the most important parts. But the most important part is this budget, from our point of view, wasn't punitive towards expats, which we're sort of relieved about. We thought we might have been the whipping boys and girls of the government's spending package, but that's not to say that the next one might be. So I've got some more questions here from Stephen. Okay. Oh, here we go. Question from Manny. When do you think interest rates will rise in the future? To be honest with you, 2 to 4 years, at the earliest. I think, to me, you use interest rates as a funding tool or a monetary policy to try and manage inflation. Inflation is not going to get above 2% for another 3 to 4 years. So what the government, what the Reserve Bank's not going to want to do is start pulling on the brakes if they feel that the economy is running away. I think it's kryptonite to the Reserve Bank to have interest rates where they are. Their sweet spot, their happy place is 2 to 3%. So they're going to want to get them up as quick as possible, but they're going to want to see economic growth and prosperity happen first before they can do that on the other side. Question from Stephen. Aside from property mortgages, have you found cost-effective leveraging for investments? Most margin loans are expensive, over 6%. Look, I think there's probably two answers for that, Stephen. The first of all is, do you really want to be leveraged in a market like this? This is the biggest economic event since World War II. To me, there's a time and a place to dial up your risk, but at the end of the day, when you're managing assets in a market like this, it's about capital preservation, saving your money first in terms of not blowing it up, and then return on capital. You can't get a return on capital if you blow it up. And to me, because we are dealing with a massive event which is magnified through data sharing and the speed and the rate that different markets and different investments can change, to me, having a very pragmatic approach to investing right now is probably prudent. There was a great saying many years ago from a firm I used to work with called Salon Swift-Barney, and the advertising slogan was, "We make money the old-fashioned way, we earn it." And that's probably a case in point in this scenario right now. There is the potential for good gains on unleveraged assets, and there will be a time down the track to dial up that risk by taking on debt to increase your exposure. The big question right now is, do you think it's an appropriate time? From our point of view, we've got 0 clients leveraged, so that probably gives you an inclination of what our expectations are. Question from Lisa. You mentioned the managed funds held by trusts qualifying for a 15% withholding tax as opposed to 30%, and also the 50% capital gains reduction yet, regardless of where the beneficiaries live. Can you go over that a little bit more? Yeah, so essentially, let's say, for example, I set up Brett Evans Trust in Australia. Now, in order for a trust to be compliant in Australia, you need to have a trustee who is an Australian. The beneficiaries can be located overseas there. If that trust were to invest in an asset, now, when you invest in assets in Australia as an Australian resident, if you hold that asset for longer than 12 months, you get a 50% discount on the. So let's say, for example, you make $100,000 on that gain, then you'll only be assessed at the rate of 50%. Non-residents as of 2012 don't have that right to get access to that 50% discount. However, up until now, if you're investing through a trust, you do. And what the new rules that they proposed back in 2018, 2019 pretty much outlay is that they don't want non-resident beneficiaries of those trusts to get access to that 50% rule. So it is a bit of a window, very sneaky sort of way to do it. It has been effective, and the government's finally starting to close that loophole. However, they haven't even drafted legislation. They haven't even put it before the House of Reps, let alone Senate. So to me, it will close. It's not something I'd recommend people do now, because you're pretty much coming at the end of the party. But going forward, you'd have to say that it has been quite a good scenario going forward. So essentially, what it means, long story short, if a trust invests in an asset and you're a non-resident, you can't reduce your tax by virtue of the 50% capital gains discount. So hopefully that answers your question there, Lisa. Question from Rob. G'day, Rob. Considering the amount of money the government is putting out there, is Australia missing a trick on reinventing our economy compared to just doing the same old things to prop it up? Completely agree, Rob. To me, what I wanted to see out of this budget was a bit of stewardship. A bit of we're going to reinvent Australia to not only survive the pandemic but come out stronger. Companies have been doing that. Companies are pivoting left, right, and centre. The government has sort of almost fallen into the trap of, let's do something that's quick and easy that we can implement straight away. Whereas, to me, I think the Australian populace and Australian citizens would have found it almost uplifting if they said, okay, rightio, we're going to do this, this, and this, big infrastructure projects, really reinventing the wheel when it comes to how the Australian economy works. So I would have preferred to see 70% of the package announced and the other 30% spent towards those sort of things. I can sort of get that the government wants to inject cash ASAP because, look, they know they are standing down the barrel of a very significant event. It's sort of, we're almost immune now to the sticker shock of, or the banner shock of what's happening in papers. But at the end of the day, we are still dealing with an event that's affected everyone. And if you believe the WHO, 10% of the world population is walking with COVID right now. So it is a big event, and you can sort of make it as big or as small as you want. But to me, it was a matter of that stewardship, and I just don't think we saw that. I think we saw something that the government said, look, let's just make the people happy, let's pump cash. But if you look at the savings rates in Australia, which historically Australians have been incredibly poor savers, 1 to 2% of their income, it's already up to 9% and forecast to rise to potentially as high as 15%. So to me, yeah, I would have liked to see more bricks and mortar type of announcements as opposed to, you know, monetary policy, which is sort of signing a pen. Okay. Any other questions there, folks? I said all bets are off. I can't tell you who's going to win the Melbourne Cup. Don't even know who's racing. Not something I watch it, but yeah, anything else that you know, you think out there that you'd love an answer to, that's always been a burning question in the back of your mind, speak now or forever hold your peace. Right, guys, well, we might leave it there. We've just crossed over the hour and a quarter mark, so I think everyone's due for a dinner or a beer or a wine or wherever you may be, lunch. So if you do have any questions, you know, as I said, you know, please feel free to jump on our website at atlaswealth.com, go to the contact page and, you know, run through some of the questions there we've got. Hopefully we can, you know, be of assistance to you. You know, I'd say that the questions that you've always had a question for, we answer those things on a daily basis. So, you know, by all means, reach out to us. Don't be afraid. The first call is complimentary. So, you know, everyone's on Zoom these days, so we can sort of get through those pretty quickly, and certainly follow the social media pages, you know, because that's where we're going to really, you know, pump out the information when it comes to keeping everyone informed. So I'll leave it there, folks, and yeah, Stephen having lunch. I love it. I'll leave you in peace and have a great lunch or a great evening, wherever you may be, and look forward to seeing you on the next session. Take